There's been a lot of news recently with the PGA Tour merging with the Saudi-ran Public Investment Fund, which owns LIV Golf. And I thought that it would be, just kind of interesting to look at some golf-specific stocks, as there has been a lot of attention on the sport lately, and just look exactly on what drama has actually played out here. So this is essentially how things played out. I'm going to give you a quick or quick little rundown here. So in 2022, Greg Norman, a legendary golfer, launched the Saudi-funded LIV Golf League and poached some of the PGA Tour's biggest stars with guaranteed contracts worth as much as $200 million. And just to get the league going, the Saudi Public Investment Fund invested more than $2 billion in 2022. Now, this led PGA Commissioner Jay Monahan to suspend multiple players for competing in LIV golf tournaments, and led LIV players to file an antitrust lawsuit against the PGA Tour, alleging it was using its monopoly to squash competition. And then this led the PGA Tour to countersue, accusing LIV Golf of interfering with its player contracts. Well, a Wall Street investment banker who is on the PGA's board, and his name is James Dunn III, ended up reaching out directly to Yasser Al-Rumayyan, the governor of the Sovereign Wealth Fund. And after months of positive discussions, they ended up drafting a deal. So according to the agreement, Jay Monahan, the commissioner of the PGA Tour, will oversee the PGA Tour and the LIV Golf League. And the PGA Tour will now control a new, yet-to-be-named for-profit entity, which combines Saudi's public investment funds, golf-related commercial businesses, with the commercial business and rights of the PGA Tour. So it's really going to be interesting to see how things play out here, especially since the PGA Tour has always been a non-profit organization. And now both the PGA Tour and the Saudi Public Investment Fund are coming together to fund a for-profit entity. But Brett sent me this actually last night, just this past Monday. So right now, yesterday, the U.S. Senate ended up opening an investigation into the PGA Tour LIV deal. So it will be interesting to see if anything comes from their investigation. So that's essentially the drama that's played out here in golf. And sticking on the theme of golf, I thought that it would be interesting to compare two golf-related stocks, which both sell clubs, bags, golf balls, basically everything and more that a golfer could need. So the first company that I'm going to look at here is Acushnet Holdings Corp, or Golf, GOLF, on the New York Stock Exchange, which owns the Titleist golf brand, which is a premium company, as many of their products, especially their golf balls, come at a premium. I thought it was kind of cool because my dad actually gave me an old Acushnet golf ball from the 70s. And you can see they have changed it to Titleist, of course. But anyways, that's just a cool little thing that I have. I've got a golf ball, an Acushnet golf ball from the 70s, which obviously they aren't putting Acushnet on golf balls anymore. Now, the other company that I'm going to be looking at is Topgolf Callaway Brands, or MODG, on the New York Stock Exchange, which again owns the Callaway golf brand and acquired the popular Topgolf driving ranges for about $2 billion in 2020. So let's compare the two. So right now, Acushnet Holdings trades at a price of about $50.50, has a market cap of about $3.4 billion and a dividend yield of about 1.6%, whereas Callaway trades at about $19.70, has a $3.6 billion market cap, and they actually suspended their dividend in 2020. Now, looking at the balance sheet, Acushnet has way less debt, with net debt of about $772 million, whereas Callaway has net debt of about $3.68 billion, which is quite a large balance there. And Acushnet also has a lower net debt to EBITDA multiple of about 2.2 times. So the balance sheet definitely is won by the Acushnet here. Now, looking at the most recent results, Q1 of 2023, revenue was up about 13% year over year for Acushnet, whereas for Callaway, it was up about 12% to $1.17 billion, and EPS outpaced for Acushnet compared to Callaway. But realistically, what we want to look for here is guidance. So the fiscal year 2023 guidance Acushnet's guiding towards revenue to be up about 6% year over year and adjusted EBITDA to be up about 5% year over year, whereas Callaway is projecting about 11% growth in revenue. EPS is going to be slightly down, or down, I guess, about 20%, not just slightly down. And adjusted EBITDA is looking to grow about 13% year over year. And as you can see from the valuations, especially on the price to earnings valuation, Callaway is trading at more of a premium than Acushnet. So, all in all, I don't know if I would say that either company is very attractive. Fundamentally, Callaway is projecting better growth, but is significantly more levered than Acushnet and trades at relatively pricey multiples, while Acushnet has posted better profitability, is projecting lower growth, is less levered, and actually has a nice dividend yield and has grown that dividend over time. Qualitatively, though, Callaway is the more intriguing name to me, as it has better growth levers, such as Topgolf, which is gaining a lot of attraction, and the company is diversifying into sporting wear as well. But at this point, given the mature nature of the golfing industry and Acushnet's better fundamentals, I would probably go with Acushnet if I had to pick one of these businesses. But realistically, I don't think that either really offer growth at a reasonable price.
Good. Yeah, I'd agree. And that net debt to EBITDA multiple of 5.5 times. That's a hefty multiple.
Exactly.
That indicates a levered balance sheet.
Seems like they levered up to buy Topgolf. Right?
Exactly. And that's what it was. So they levered up to buy Topgolf.
And we'd have to look at what type of debt that is. Is it a variable rate, fixed rate, and how long it's amortized over. But it's a high net debt to EBITDA multiple right now. That has to come down. Or else, especially in a rising rate environment, it is a bit concerning. But there's not enough growth here to really be interested in either company right now, to be honest. Even adding Topgolf, which apparently was growing at a decent clip, at least, it hasn't moved the needle enough to where you want to pay 12 times EV to EBITDA in a highly leveraged company, or 30 times PE, right? It's difficult to pay that when you've got just low double digits, like 13% maybe growth in that range. EPS is actually down. We'd have to look at cash flow growth and everything like that as well. But I don't think either way, it's not enough growth to really be interested in either of these companies.
Agreed.